All right, Mindy, are we recording? And then we'll go ahead and get started.
We are. We're ready to go.
All right, wonderful. Well, welcome everyone to part 2 of the Introduction to Investing webinar series. I am so glad that you are joining us again. My name is Nicole Huff. I am an assistant extension professor with Family and Consumer Sciences here at the University of Kentucky. I am an extension specialist in family finance and resource management. And it is always such a pleasure when we have the opportunity to partner with industry professionals. And we are very excited to have Dr. Woodrow Johnson with the Securities and Exchange Commission with us again tonight. And so welcome. And just a couple of housekeeping things, and then I will turn over the webinar to Dr. Johnson. The webinar, like last month, it will run for about 60 minutes, give or take, and then there will be a period of Q&A. And so your cameras and microphones in this webinar have been disabled. Please use the Q&A box to enter questions for our presenter. So don't use the chat, use the Q&A box. And then like last month, you will have the slides, the recording, and an evaluation link sent to you sometime tomorrow so that you can refer back to all of this information. At the end of the webinar, during the Q&A portion, we will also include a link, and we would love for you to go ahead and take a snapshot of that on your phone or click the link in the chat box so that you can take our evaluation. Your feedback is always important to us, and it helps us improve the programming that we deliver to you. All right, and so if you weren't able to join us for the first webinar, I do want to reintroduce our presenter. And so we are joined again by Dr. Woodrow Johnson, who is a senior financial economist with the U.S. Securities and Exchange Commission, or the SEC. And so I'll just read a brief bio of Dr. Johnson, just so you know what good financial hands we are in. And we are so excited that he's sharing his expertise with us again. And so Dr. Johnson is a senior financial economist in the Division of Economic and Risk Analysis at the U.S. Securities and Exchange Commission. During his dozen years at the SEC, his primary focus has been on rule writing and enforcement, particularly on matters related to mutual funds. For the last 3 years, he has served as the senior advisor to the SEC's chief economist. Before joining the SEC, Dr. Johnson was on the finance faculty of the University of Oregon and the mathematics faculty of Truman State University. He earned a master's degree in mathematics from the University of Tennessee at Knoxville, and us Kentucky fans will forgive him for being a Tennessee alum. And from Columbia University in New York City, he earned both his master's degree and a doctoral degree in finance. So, Dr. Johnson, again, we are great to have you. I'm going to stop my share and let you go ahead and share your screen, and just take it away when you're ready.
Well, thank you for not holding Tennessee against me. I recall vividly my 2 years in Knoxville, and I do know that people in Knoxville are aware Tennessee exists. So that is true. So let me hit that button there. Okay, hopefully you see that. I'm really excited to be here again to continue the conversation we started last month about investing. We've covered a lot of material, and I look forward to talking about more topics this month. A little more advanced, perhaps, than last time, but still semi-independent from last month. If you missed last month, I still think today will still, I think, make sense for you, hopefully. Need to. Okay, I need to give my normal standard disclaimer. I'm speaking here as a public service for investors. Please don't interpret the presentation to be one of official policy or legal interpretation. I'm not here to give you investment advice. Just to give you some, think of this as a personal conversation, one-on-one, about me giving you some ideas about what to think about as you make your investment decision. We're going to do primarily 4 things today. I want to talk about first the SEC. You know, what role does the SEC play in the financial market? Number two, talk about risk. We'll spend most of our time talking about risk, I think. I want to talk about, I changed the order here, 4 and 5. First, talk about retirement. Then after that, talk about fraud. And as Dr. Nicole mentioned, we'll do, Dr. Huff, sorry, we'll do Q&A at the end. So first off, a little mini review. If you were here last month, we talked about many things, but along the way, I highlighted 4 key decisions that investors make in the market. And whether you know it or not, you're making 4 decisions along the way. The first decision you make is always, do you want to invest? That's a choice. For some people, the answer is yes. For others, the answer is no. On that note, let me be very clear here. For these 4 decisions that everyone has to make, there is no right answer. For some people, they pick one choice. For other people, for good reason, they pick a different choice. So you and your neighbor very well will make different decisions here. And that's okay. I mean, that's how it should be. Everyone's individual facts and circumstances are different. So based on you, your needs, your wants, your plans, expectations, whatever, you may choose something very differently from how I choose how I make my investment decisions. Choice 1, do I invest? Choice 2 is, do I want to make my decisions by myself, or do I want to hire someone to help me make my decisions? For example, do I want to hire a financial planner to help me make my decision? Choice 3, do I want to invest directly in assets, such as stocks and bonds, or do I want to invest indirectly through a vehicle, such as a mutual fund or an ETF? Again, no right answer, matter of preference, but that's a choice to be made by you at some point in the process. And the last choice is, one of the last 4 big choices is whether you want to invest actively or passively. Now, if you're a new investor, everyone is at some point, probably walk in thinking, of course, I want to invest actively. I want to buy and sell stocks to make money. That's sort of the way people think about the financial market. But once you get into it for a while, maybe after a month or after a year, at some point you realize there's a thing called passive investment, commonly called index investing. And for some people, that may make sense. For others, it won't make sense. But those are 4 choices you have to make. In that spirit, I want to mention last time we talked a little bit, or I gave some survey questions that addressed those big decisions to make. One of them I asked the audience was, have you invested new money in the last couple of months? So really, I was asking that question, are you an investor or not? And to that question, roughly a quarter of the respondents said they're not yet investing. For them, I say, you're doing the right thing, right? Learn about the markets, learn about investing, learn about stocks and bonds and mutual funds, learn about risk, and then decide whether it's appropriate for you at this point in your life to invest or not. I also asked a survey question on where you invest your money. Are you investing mostly directly in assets like stocks and bonds? About 40% said yes. Or do you invest primarily in mutual funds and ETFs, exchange traded funds? About an equal number, 40%, to that question said they primarily invest there. The other 20% said they invest in other kinds of things. Right? The markets are complex. There's a lot of things out there. Stocks, bonds, and mutual funds, derivatives, options, currency, portfolios. There are lots of ways to invest. So what's best for you? I don't know. Look around, do some research, and figure out for your needs, your circumstances, your facts, what's best for you. I also asked a survey question on, are you active or are you passive? And roughly 20% said you're active, by and large. And about half of the respondents said they are mostly passive. The other 30% or so said they do both strategies, or some people said, I don't know what I do. I don't know the difference. Fair enough. Passive investing is kind of a new topic for most people when they first start investing. We also last time talked a little bit about compound interest and the virtues of investing regularly over a long time period, and how time matters. It's an asset. The longer you invest, the better off you're going to be typically in proceeding. I want to end with, I can't call this advice because I don't give advice. Let me call it a suggestion perhaps. But if you're going to invest, especially if you've already started investing, I want to ask you, why are you investing? So specifically, why are you there? What are you trying to accomplish? And many people say, I want to be rich. What does that mean? Or some people say, I want to invest for my retirement. Well, what does that mean? Well, I want to have a comfortable retirement. Like, what does that mean? I encourage you to write down a specific goal. Be concise. If you don't know, Lewis Carroll, right? He said, if you don't know where you're going, any road will get you there. And Lewis and Carroll, Alice in Wonderland. You don't know what you're trying to accomplish. How are you going to get there? Like, what are you going to do to get there if you don't know where you're going? So be specific, be precise. Write down on paper, black and white. You want to accomplish the following 1, 2, 3, or 4 things. And once you know specifically what you want to accomplish, that will help you figure out today what you should do in the financial markets to get there. We talked a little bit, not during the main session, but afterwards in the Q&A session about investing apps. So a couple comments about them from that Q&A session at the end of last month. Today, unlike 10 years ago, you can invest effectively on your cell phone. There are a couple different cell phone apps that are quite popular. Many people use them. You can buy and sell different securities, their device. Make sure your investment app is registered. But in the real world, when you talk to people or an investment firm, people that give investment advice, brokers, dealers, investment advisors, they must be registered with the SEC. So too must their underlying company. That also applies, curiously enough, to software, right? So if your investment app, it gives you advice and tells you what to buy, how to buy it, when to buy it, that app must be registered. So ask, is it? Figure out, make sure it is before you proceed with that app. Keep in mind a couple of things. Number one, these apps, they may introduce you to certain investment products that may not be appropriate for you, especially if you're a new investor. It's not obvious to me that you want to be involved in super complex, super technical, super high risk strategies or products, but that app makes it easy for you to find those things and may tempt you to invest in those products. So before you do that, think twice, make sure those strategies, those securities are perfect for you at this time. If they are, understand for you, for your risk tolerance, for your situation, how you should trade those, to what extent. These investment apps typically, for full disclosure, on my phone, I have no investment apps. I've actually never used one. I've actually never seen one in the same room as myself before. So I don't know how they work, right? But I read about them in the newspaper, and in the newspaper, I learned that many of these products, apps, have low fees, maybe even no fees. Go to this app, download it, no cost, put money into some account, and then buy and sell stocks or options or currencies or whatever kind of security out there at no cost to you. That seems to be true. If that is true, I have to wonder, well, so why not? In the real world, when I buy things, when I buy couches and raisins and sailboats, that costs money. So why can I buy online through this app for free? That seems really weird to me. Someone made a point to me years ago that if you are not the customer, you're the product. I have to wonder what's going on here. Find out how these apps are making money. They're making money somehow. They're not there for charity reasons. If your interaction with them is free, what's the catch? Find out before you proceed. Last point here really quickly is these apps tend to, on the newspaper I read, they do things like have confetti and certain noises, and they remind people about the portfolio. And maybe that happens once a week or once an hour, once a day, once a minute, I don't know. But maybe that encourages you to trade more often than you would want to otherwise. So be careful, right? Madison Avenue works, marketing works. The more often you show me a picture of ice cream, the more ice cream I'm going to eat. The more often you tell me, hey, you look at a portfolio, you should consider trading, the more often, on average, I'm going to trade. So be careful that these apps don't entice you or trick you or persuade you or give you the incentive to trade the wrong assets or the wrong assets at the wrong frequency. Be mindful of what you're getting into. With that, let's get into some new topics here. Talk about the SEC really quickly. The SEC has three missions. Number one, protect investors. Number two, maintain fair, orderly, and efficient markets. Number three, facilitate capital formation. So if you are a corporation, for example, and you want to build a new factory, that costs money to do that. So where might that come from? The U.S. capital market? You might want to issue bonds. You might want to issue equity. But either way, the U.S. markets, if he wants them to be efficient and designed such that you, the firm, can raise capital for your worthwhile enterprise. Protect investors. So how do we do that? Well, we do that by giving workshops like this to the public, so you can learn a little bit more about the market and learn a little bit more about what you can do to be a wise investor. These are workshops that are designed for retail investors, so mom and pop investors, people like me and you. We also have, the SEC, we have a website designed for retail investors. The main website, sec.gov, is designed for everyone. You are a hedge fund investor, if you are a corporation, you're a regulator, you'll come here and learn about the SEC. But if you are a mom and pop investor, a real person, a retail investor like me or you, you're better served probably by going to the website called investor.gov. We'll get there later on today, but investor.gov is designed for people like me and you to, again, protect investors. What do? We do a number of things. We write rules in an effort to maintain fair markets. We look at disclosures that are made by public corporations. We'll make sure they're disclosing the right things to the public so people know what's going on in the business. And we, of course, want to enforce federal securities laws. Every year, a lot of firms pay a lot of fines because they do things, they make violations of securities laws. Sometimes intentional, sometimes not. When possible, if investors have been harmed, we try to repay that harmed investors some of their losses. Not all of it. We can't usually recover all the losses, but if we can recover losses, we do give money back to investors that were harmed. We regulate, this is maybe news to you, but a lot of things, a long list. I want to highlight either number 2 and number 3. There are roughly, say, 7,000 stocks in the stock market, a lot of stocks. But even bigger than that, it's just kind of funny when you think about it. There are 10,000 mutual funds and ETFs that invest in those stocks. That's kind of weird. Why so many? Hard to tell. But there are a lot in any case, a lot to choose from. So whatever kind of product you want, risky, safe, tech stocks, pharmaceutical stocks, international stocks, bonds, short-term, long-term, higher risk, low risk, whatever you want out there somewhere in the financial markets, probably, not guaranteed, but probably, is a product, is a security that matches your preferences. That might be good for you. So look into it. If it is, invest in it. If there's not one, then by all means, take a pass. The markets are big in terms of dollars. So the SEC oversees $100 trillion roughly in registered investment advisor money. High turnover. Now, people like me and you probably don't trade too often, but there are certain types of investors, call them HFT investors, high frequency traders. Certain kind of specialized hedge funds, for example, do this, and they trade actively. Because of those kinds of investors, turnover also is really high, roughly $100 trillion per year. Risk. Risk is a big topic, and we could literally spend hours and hours and hours and hours just talking about risk. In fact, there are books, big books, that talk about risk only. We can't for tonight, right, clearly? But for a couple of minutes, let me say a couple of things about risk. Let me start with this slide. This is a fun slide for me because whenever I see cubes, I think of dice. And dice for me is an illusion for games of chance. Think Monopoly, think Risk, the game Risk of all things. And games of chance make me think about gambling. This raises a question then in my mind. At the end of the day, right, is investing really just like gambling? When I read the popular press, the newspapers, magazines, blogs, websites designed for people like me and you, every once in a while I see an article where someone says, hey, Wall Street, it's like Vegas, gambling. So what do you think? Ms. McCullough, if you don't mind, could you please load survey number 1? I wanted to do a couple surveys as well today. Here's one of them. Just a knee-jerk reaction in 10 seconds. What's your thoughts? End of the day, is investing just like gambling or is it different? As a professor at Oregon, I taught investment to undergraduate and graduate students. And every semester, my final exam included this question. Same, different, why not? So let me go ahead and push the in the full button. Get a chance, hopefully. Looks like, push the button here. Hopefully everyone can see those results. The answers are about a third said yes and 2/3 said no. So they have a lot in common, don't they, right? Both of them have uncertainties, right? If you go to Vegas and you play roulette, right, this wheel, ball rolls around it, falls into a bin, number, red or black, for example, right? When you spin the wheel, it might be red, it might be black, right? For Wall Street for next year, the market might be up, might be down, the same. Use similar language, right? There's risky, don't know what you're going to get, unknown, what's the risk aversion? You want to take a big stake in it or a small stake in it. And the roulette wheel, right? You can put down, $1 million portfolio on the red number 2, and if a black ball comes up, you lose everything, right? You can lose your shirt. Well, in Las Vegas, but so too in Wall Street, right? If you buy the wrong company, you're unlucky. You could lose everything in Vegas too. Sorry, in Wall Street too. Lose your shirt there as well. You could also though make a fortune if you put your portfolio all on the red too. You may be lucky, and the ball may land in that bin, and you may win an eye-popping amount of money. You'll walk away filthy rich. Same too with investing, right? You may put all your money into that one stock, and that one stock may be the big winner, and it may go up by 1,000,000%. And you may walk away just super duper rich, right? Same thing, right? So these things seem very similar, like investing, gambling, Wall Street, Vegas. What's the difference? Well, so the difference is, so this is kind of subtle, maybe, but the difference is, when you go to Vegas, you play a game of chance. When you do the roulette wheel, what do you expect to happen? You hope to win, right? But in expectation, you play the lottery. I don't know if Kentucky is part of the Powerball lottery or not. You play the Powerball lottery. What do you expect? The expected winnings are going to be negative. Right? You expect to lose. On the roulette wheel, half the bins are black, half the bins are red, except also a bin for the number 0. I think it's usually green. So actually, I've never played roulette. If I get the words wrong, I apologize. I looked up in Wikipedia about roulette. This is what I learned from Wikipedia last week. Wikipedia says there's also a number 0, which is the green typically. If the ball lands in the green bin, the house wins, right? So it's like 50-50 odds, black or red. But if it's green, that one ball, that one bin, the house wins. So usually it's kind of close to 50-50, but it's a small chance the house wins. So on average, on net, you're going to lose. The house wins. Slot machine, same thing. On average, you may win some, but on average, the house wins 2, 3, 4, 5% of every pull on average. In gambling, the expected winning is negative. In other words, you expect to have a loss. When you buy a lottery ticket, you expect to lose on average. Right? On the other hand, Wall Street, when you invest, suppose you buy a share of stock, the stock costs, say $10, right? What do you expect? And you hope that a winner, you hope the stock price goes to $20 in a year. Maybe you're wrong, and it may fall down to $5, may go to $0, lose everything. But what do you expect? Well, on average, the stock market goes up historically by 10% per year. So you might expect to go up by 10%. So the price might go from 10 to 11. You expect to earn about $1 from holding that stock for a year. That's called a risk premium. And in the financial markets, the risk premium is positive. So that's a term of art. the equity risk premium in the US stock market is positive, you expect to make money. So that's the key difference. In Vegas, when you do a game of chance, you expect to lose. You hope to win, but you expect to lose mathematically. In Wall Street, you hope to win a bundle. You might lose, but you expect to win because mathematically, in expectation, in the stock market, in well-designed, well-run, efficient, nice stock markets, the expected winnings or earnings are positive. So that's the difference between investing and gambling. Dow Jones. You may hear this on the radio, on TV, the nightly news report. The market goes up, market goes down. One way to capture that is the Dow Jones Industrial Average, or maybe, for example, the S&P 500 index. Here's the Dow Jones over the last 30 years. When I look at this picture, what do I see? Well, I see volatility. I see the market went up some days, some weeks, some months, some years even. Other periods, the market went down. In some periods, it went up by a lot. In others, it went down by a lot. This is 30 years. And over that 30 years, if you held stock for these 30 years, from the year 2000 to the year, actually before that, 1990, I guess, to the year 2020, you made money. You made a lot of money. So good for you. So short term, there were many periods in which you lost money. You would have lost a lot of money. But over the whole 30-year period, you did pretty well. If you look back to the U.S. stock market over the last 100 years, over the last 30 years, there were many days, weeks, months, years, even a decade, where the stock market went down, you had a negative return, where you lost some money in that time period. But over a 30-year period, there's not a single consecutive 30-year period in the last 100 years where the stock market lost money, at least a nominal term. So that says, to some people, over the last 100 years, the stock market's been a great place to be if you were a long-term investor. Okay, that's backward looking. Looking forward, what do we expect for the next 30 years? I can't invest in the past. The past is gone. But looking forward, for the next day, week, month, year, decade, 10 years, 30 years, 40 years, what's going to happen? I have no idea, right? That's risk. I don't know. I know that in the past 100 years, not a single 30-year period had negative returns. So in the future, for the next 30 years, am I guaranteed positive returns? Absolutely not. It's risky. Hopefully positive. I expect positive. In today, though, it might be negative over 30 years. Hope not. It might be. So what do I believe? If you ever read a mutual fund prospectus or an ad sponsored by a mutual fund company, you'll see this phrase. Past performance is no guarantee of future results, or past performance is no guarantee of future return, right? The past does not perfectly predict the future. I look at the past, it helps me learn quite a bit about risk, but it does not guarantee future. Given assets in the financial market, I can group them into different categories. And three common categories are cash, bonds, stocks. So stocks, it turns out, if I look at the historical record over the last 100 years, are the riskiest of these three kinds of assets. They also, though, have also the highest return. Cash, things like literal cash or treasury bills or bank CDs or bank deposits or things like commercial paper, historically had very low returns, but also very low risk. Bonds are in between. Historically, they've had risk between that of stocks and cash, but also returns between that of cash and stock. So these are the two dimensions that we care about typically when we're talking about risk. For a given security, stock, a bond, treasury bill, whatever, look at the risk return profile. For every unit of risk you take, how much return do you expect to get from that asset? Again, this is ex ante returns, or risk or return you expect in expectation. But ex post, the return might be very different from that. Right? So stocks have higher risk, And we hope higher return than cash, the treasury bills, and usually that's true, but not always, right? So that's the risk you face. Thinking about trying to minimize risk or manage risk. As an investor, if I'm going to put my money, my hard-earned capital, paychecks, into the stock market, the bond market, I want to try to reduce the risk. That amount of risk, I want to maximize the expected return. So one way to do that is through a technique called diversification. Let me give you two definitions or two descriptions of diversification. The first one is called basic. The basic view of diversification is, the old adage is, don't put your eggs in one basket. Don't put all your eggs, rather, in one basket. Split them up. All your eggs in one basket. If that basket fails, the bottom falls out. You've lost all the eggs, lost all your breakfast. You don't get to eat. That's tragic. So instead, put your eggs in 2 or 3 or 10 baskets. That way, if any one basket fails, the other survives, and you still have enough food for breakfast. That's the simple version. The more advanced version takes me a minute, but let me try to explain this really quickly here for you. Back in the old days, by old days I mean before 1952, so back in the 1920s and 30s and 40s, when investors were making their investment decisions, they'd look around and they'd find the best stock, or maybe the best 2 stocks, and they'd put all their portfolio in those 1 or 2 stocks. In 1952, Harry Markowitz published a paper in Journal of Finance that totally changed the worldview of investing. Introduced an idea called portfolio theory, which is driven by an idea of diversification. His insight was that a given stock has risk, yeah, but has 2 kinds of risk. The first kind of risk is market risk. The second kind of risk is firm-specific risk. So the first risk is, for example, market risk. So all assets, all stocks face this risk: the risk of inflation, the risk of high oil prices, the risk of high unemployment, the risk of war. So whatever kind of company you are, those kinds of risks affect everyone. The other kind of risk are firm-specific risks, risks that affect only 1 or 2 or similar firms. So for example, if I'm a pharmaceutical company trying to find a cure for cancer, I have some research going on. I do my research, and I think to myself, my firm thinks to itself, hey, this pill will cure cancer. That's risky for that firm and no one else really. If I'm right, if that pill cures cancer, that's a gold mine, right? I'm going to be a very, very successful company, very wealthy company, good for me. On the other hand, if my best idea doesn't cure cancer, my company's worthless. My firm value goes to 0, right? So that drug is specific to that firm only. That's a firm-specific risk. Here's one more example. This is silly. Suppose one day, for whatever reason, the Surgeon General of the U.S. stands up and says, orange juice is dangerous. If you drink it, you'll get cancer and die in a week. Okay, will never happen, but suppose fairy tale land it happens. What's going to happen to every company that makes orange juice? Well, no one drinks it anymore, so those firms' stock price goes to 0. Right? That's a firm-specific risk that affects orange juice companies and not computer companies, right? And not car companies, like no one else but orange juice companies. So Markowitz, going back to him, so 2 kinds of risk: market risk and firm-specific risk. His insight was, the paper's full of mathematics, but ignore the mathematics. The insight is that as you look at your portfolio and you make investments, I buy stock 1, I buy stock 2, I buy stock 3, all those stocks have market risk. So when formed together, collected together into one portfolio, that risk does not change. However, the other kind of risk, the firm-specific risk, as I buy my orange juice company and my pharmaceutical company, and I buy my oil company, and I buy my car company, and I buy my tech company, those companies have different kinds of firm-specific risk. So as my portfolio is formed together with those, not 1 or 2, but 5 or 10 or 15 20 different stocks, when they are pulled together into one portfolio, that risk gets smaller and smaller and smaller. And that makes my portfolio have less and less and less risk. It does not change the return on the portfolio, just the risk, and that's a win for me. So that's the idea behind diversification. So whether basic or simple, either way, 2 points. Number one is, as my portfolio has entered more and more stocks, the risk goes down. That's a win for me. As an investor, I want more return and less risk. This is a win. The other idea here is that as an investor, when I make a portfolio, don't think of my portfolio as being a collection of 5 different stocks or of 10 different stocks. Think of the portfolio as an overall portfolio together. And what I care about is not how that one stock went up or went down. I care for the entire portfolio. Does it go up or does it go down together? Okay, that's the difference. Thinking also of risk, another important idea is asset allocation. We talked before about bucketing assets into big categories: cash, bonds, and stocks. Suppose, I don't know why, just you wake up one day and randomly, for whatever reason, your portfolio is 10% cash, 30% bonds, and 50% stocks. So 10, 30, 60. Just pretend. Would you ever want to change that? So somehow you have that portfolio. Is there ever a reason to deviate from your current asset allocation? Well, suppose you decide that you do some research and you decide through your research that next year is going to be a good year for stock. Stock market will double next year. So we'll get returns of 10, 20, 30%. If you believe that, then what should you do to your portfolio allocation? Well, in that case, if stock's going to be good for next year, by all means, sell your cash, sell the bonds at 40%, take all of that, put it into equities. Portfolio then is like 100% equity. On the other hand, if your forecast says stock market's going to tank next year, returns might be 0 or -10, -20% next year. If that's your view, by all means, sell stocks, then now buy cash and buy bonds. Okay. So why might you want to change your asset allocation? Well, one reason is called market timing. You have a view on future asset returns. You want to adjust your portfolio to be more heavily weighted of assets you think are going to do well next year, next period. So that's one reason. The second reason is, let me ask you this question. I'll ask the question and then have a little survey of the same question. Suppose my portfolio, again, 10, 30, 60, cash, bond, stocks. I pick that because I'm going to use my portfolio in 1 year to buy a new car. Okay. Suppose, though, my plans change. I want to buy a car not in 1 year, but in 10 years. So same portfolio, but my horizon is now longer. Not 1 year, but much, much longer. It's 10 years longer. If my horizon increases, would that affect my portfolio today? That's the survey question. If you don't mind, could you please load survey number 2? Curious on your thoughts here. If you have a longer horizon, are you going to hold a different portfolio than if you have a short horizon? Ms. McCulley, are you here?
I am. We're having a little technical difficulty with the poll. Here we go. I think we got it. There we go.
Perfect. Okay, just don't think too hard about this. This is not rocket science. Just your immediate reaction, knee-jerk. Yes, you hold more stock. Yes, you hold less stock. Or no, won't change. Or you're not sure. Okay, all my questions, by the way, are questions that don't really have right answers. These are just your opinion. Reasonable people can disagree on the right thing to do. Let me go ahead and end the poll here. Hopefully, most people at least had a chance to answer it. There. most common answer was, as you wait, share the result. We can all see it. So the most common answer, as you can see, is yes, I would hold more stock. Over half, say 2/3 almost, gave that answer. That, in fact, is a very common answer. If you read the popular press, you talk to many stockbrokers, I think, I'm going to guess here, I'm not sure, but I'm going to guess. Most stockbrokers, I'm going to guess, most financial planners, most investment advisors, they're going to tell you, if your horizon is longer, you can afford to take on more risk. Therefore, you could hold more equities, more stock, more of the risky asset. That's quite common. A lot of people say that. Articles about that you can find everywhere to read. That's pretty common. This is called time diversification. Again, time diversification. However, although most people say that, I do want to give you a super duper advanced topic for your future consideration. So right now we're doing like part number 2. If we were doing part number like 4 or 5 or 8 or 9 or 10, I would tell you more about this topic. But really briefly, there are people out there that say time diversification is a fallacy. And no matter what your horizon is, your portfolio should not change. If you're going to hold 10, 30, 60 today for a 1-year horizon, if you extend your horizon to 10 years, that portfolio choice, 10, 30, 60 should not change. Okay, so some people, I think the minority, say this. If you ever want to, you're bored in 2 years, and you want to go down that rabbit hole to figure out why. Why do some people say time diversification works, and some call it a fallacy? If you go down that rabbit hole, I'll give you a hint before you get started. And the hint is both sides have good arguments for why they are right, the other side is wrong. They hinge on what you mean by risk. If we talk about today, the risk for 1 year is something, and over time, over 10 years, that risk goes down. The question is, like, what risk specifically, concisely are you talking about? There's more than one way to define risk. I could die tomorrow, right? That's a risk I face. I could die from a heart attack. I could die from cancer. I could die from falling down the stairs. I could die from a meteor. But who knows? From gunshot wounds, who knows, right? There's different kinds of risk, same thing in the stock market. The question is, when you talk about risk declining over 10 years, what kind of risks are you talking about? I could write down a couple of risks that would decrease over time. Also, other risks that turn out increase with time. So the question here is really on what kind of risk do you care about? And are those risks over 10 years declining or not? Okay. Again, that's an advanced topic for later. That means don't look at it now, maybe. You could if you want to. But if you're still studying and investing in 3 or 4 or 5 years, look into it. Kind of fun to look into. Yeah, so this picture here ties into time diversification. There are people that say, again, the majority, I think, it looks like, that say that if you are saving for the longer time, you're younger, you're 25, you're saving for retirement 40 years away, your portfolio might be more towards equities than it would be if you're, say, 55, saving for retirement in 10 years. Similar idea here too on diversification. Next topic, let's talk about retirement. What can I say? There's a lot to say about retirement. People are of different ages. Are you 25, 35, 45, 55? Are you 85? That will affect your view. But this is a background terminology. I think it was in the Tax Reform Act of 1978 that Congress passed some tax changes that eventually led to what we now call 401k plans, or 403b plans, or 457 plans, or 401a plans. But these are employer-sponsored pension plans, defined contribution plans, that enable the employee to save for retirement through this plan. Back in the mid 70s, I think it was 1974, Congress passed a different law called ERISA. And that law created what we now call IRAs. These two plans are both vehicles for saving for retirement. The first is linked to your employer. Second is not. In the first plan, you can save more per year, currently almost $20,000 per year. This is indexed to inflation, loosely speaking. So every year it goes up by a little bit. Typically, your employer-sponsored plan is going to give you, I'm not sure typically, maybe not the majority, maybe not though, but many plans at least will do a dollar match. So a generous plan, for example, might, for every dollar you put in, match it by $1 up to say 3 or 5 or 8% of your salary. And that money stays there in some selection of mutual funds offered by the 401k plan until you either leave the firm or until you retire. Those contributions go in tax-free, and then when you retire, you cash it out, say 65 or something, that comes out as taxable income. IRAs are more flexible in the sense that you can invest in a bigger variety of products. It's not linked to just your employer. You can invest in Fund A, Fund B, or in stock brokerage company number 1, stock company number 2. You can even take it to a bank and buy CDs through an IRA vehicle. But either way, though, the investment goes tax-free up until you retire, at which point it is taxable. We now have today two different tax treatments, maybe, of these vehicles. The first, the traditional way, is that your money goes in before you pay taxes on your income. So you earn money from a job, and that money pre-tax goes into the vehicle, either the IRA or the 401k plan. And then at the end, when you withdraw the money, it's taxed at that point. The Roth plan is that you earn money today, you pay taxes today, the money grows tax-free, and then when you retire, you can cash it out tax-free. So the difference here is between traditional and Roth is taxes. Do you want to pay taxes today? If so, choose Roth. If you want to pay taxes later, then choose traditional. So that's the difference between the two. Ms. McCulley, can you pull up survey number 3 for us? So a question to ask here would be for you, for today, which plan is better, the traditional plan or the Roth plan? What are your thoughts? Is one better? Is the other better? Are they the same, or don't know, flip the coin? This is a tricky question, actually. It's tricky. It's tricky because there's more than one way to read the question, I think. Let me give you 2 more seconds to think about it. So let me end the poll early, maybe, and then show the results. 3, 2, 1. So almost half said the Roth is better. 20, a quarter said traditional, a quarter said can't tell, flip a coin, and 1 person said everything. So let me give you multiple answers. My first answer is they're the same. It's identical. There's no difference. If you do the math, it turns out that whether you pay taxes now or later, either way, you end up with the same. So my first answer is the third one. They're identical. That's my first answer. My second answer is, well, it depends. And the difference, the issue here is the tax rate. So the idea of the original plan, traditional plan, was that today, when I am earning money and 50 years old, peak earning at a high tax bracket, so I pay high taxes at a high rate. So I want to invest on a tax-deferred basis, not pay taxes today, and then when I retire, I'll have less income, no job, less income, I'll be at a lower tax rate. So I withdraw the money at that point, I redeem it, withdraw it at a lower tax rate. So if that's true, if I pay a higher tax rate today than when I retire, and better off in the traditional plan. So if that's your view, that for you, your tax rate goes down. For example, your income level goes down, then you're better off in traditional. On the other hand, you might think your tax rate will go up. You are 20 years old, you're young, just getting started, you're working at an entry-level job for a low rate, your tax rate is low. You think that as you get older, you'll get more training, more skills, better jobs, make more money, and you're going to, knock on wood, retire as a millionaire. And you expect to have more income when you retire than you have today, so you expect a future higher tax rate. If that's you, then by all means, pay taxes today. The Roth plan, you're better off than if you have a lower tax rate today. So both those make sense. So I'd say, you know what, answer one, answer two makes sense. So far I've said 3 answers are correct. And now let me say for the last people, the 3 that said impossible to tell, so the one more piece of uncertainty is, maybe I can predict future income and future tax brackets, maybe, but what I can't predict is Congress, because now I have a certain tax code, certain tax buckets. In the future, Congress might change tax rates substantially. So although today I expect to be in the future at a lower tax rate, the traditional people, Congress might, next year or 10 years or when in the future, increase my future rate. So in that sense, flip a coin, I can't tell, right? So in some sense, they're kind of all the same. But mathematically, if tax rates are the same in both periods, they are identical. Your return will be the same either way. So to make a choice, you need to think about tax rate, whether for you, Congress, your income, will your tax rate go up or will it go down? And based on that forecast, that prediction, that view, that opinion, then choose traditional or Roth. Big picture, some tips. Don't delay. The sooner you start investing, the better off you're going to be in your pension fund. Many, not all, but many 401k plans offer a match. If your firm offers it, by all means, take it. The match might be dollar for dollar, or it might be for every 2 you put in, they put in $1. Whatever it is, it's an immediate return, right? If it's dollar for dollar, it's an immediate 100% return. By all means, take it. Great investment. And do, of course, watch the fees over time. The fees do add up over time. Make sure you don't pay too much. They're reasonable for the services you get. When you do switch jobs, if you switch jobs before you retire, typically you have a choice on whether your pension plan stays with the firm, or you can choose to transfer into the new firm's pension plan, or you can roll into an IRA. Those, I think, are the most common options. Some people, when they change employers, choose to cash out their pension plan, like a lump sum distribution. If you choose to do that, be mindful, if you're young, you'll pay a tax penalty for that choice. A couple comments here in the last, I'd say, 5 minutes. We talked last time about fraud. Just highlight some of these things again, right? A lot of people want your money. Just to be really candid, right? If you're an investor, you've got some money, maybe small, maybe a lot, don't know what it is, but whatever you've got, the more you have, the more the bad guy wants your money. Be very careful. You're honest, you trust people, but there are a lot of crooks out there that will lie, will cheat, and will steal to get your money. I gotta tell you, these fellows, these women too, these individuals, they dress well, they speak very distinctly, good vocabulary, they speak with big words, they sound professional, shiny black shoes. You trust them. They have good charisma, but they're committing fraud. They want to steal from you. So be very careful before you put your hard-earned money from other. If they tell you, surefire, no risk, double your money, that is in my mind going to be a fraud. Like 99.999%, that's going to be, those words are fraud. In the financial markets, you typically get returns like 10% per year in expectation. You don't get a guaranteed return of double your money. The people that are trying to get you to buy now, that's going to be usually fraudulent. Any good investment, you can wait a day or two or a week. If people ask you, cold call you, if they're a stranger, be very, very wary before you invest with them. Most cold calls are fraudulent. Before you invest, you want to make sure that your professional that you work with is a licensed, registered investment advisor or a broker. In the last 2 minutes, a couple of commission resources that we have available for you. We have, as I mentioned earlier, the website investor.gov. This is targeted for, geared for, designed for people like me and you. So I refer my mother here. I refer my cousins here. I refer my niece and my nephew. My children have all said, go here, look around, see what you can find. In particular, look here at this, on the top blue bar here, the second box, tools and calculators. That's a very common, popular site on this website. It's a good tool there for compound interest to see how a portfolio can grow over the years. Take a look at that sometime. The website also works well on cell phones, so you can look on your phone as well as your computer. We have on the website a lot of information. It's like a library of like little 1 or 2 or 3 page little briefs or memos, if you will, on different topics. For example, what is a mutual fund? What is an ETF? What does ESG mean? What are index funds? What are risks associated with social media? Have those kinds of briefings, booklets on the website. By all means, take a look at those at your leisure. My office, the Office of Investor Education Advocacy, has a toll-free number and also an email address. Any questions, any problems, give us a call, send an email. If you have been a victim of fraud, especially, if your father was victimized, if your great-great-aunt was victimized, your cousin or whoever, contact us, please. And we'll try to help you. Now, for sure, we make no guarantees. And that money very well is gone forever. You'll never get it back. But maybe, just maybe, we can help you find the bad guy, get back, not all perhaps, but part of your earnings. You do Facebook, you do Twitter, you can look at us there as well. With that, I think we're out of time here. So let me turn the time back to Dr. Huff for Q&A. If anyone wants to ask any questions or just want to verbalize vocally, answer the question.
Yeah, thank you so much, Dr. Johnson. I know someone in the chat put that the SEC has great resources, and I agree. And I think that that is something helpful, especially to have to go back through and review those resources. Once I know that you're going to share your slides with us, and so those are very helpful resources to have. We do have a few questions that have come in. Okay, so the first, is it smart or not so smart to invest some in both traditional and Roth, or is it better to pick one?
If you have strong views on tax rates and what they'll be for you, right? You know today your current tax rate pretty closely. You don't know your future tax rate. The question is, in the future, will your rate be lower, a different tax bracket, or higher because of the tax bracket change or because the Congress changes the tax law? If you have strong views, then put your money in that asset that's for you. If you don't, yeah, you could call this hedging, right? Split the difference, put half one way, half in the other. That way you're not too far off from that. So that's a reasonable approach, like split the difference. But if you're confident,
Right, just for participants who are listening during the Q&A, I have just switched the screens to put up the evaluation. And so make sure that, and I believe Mindy is sticking that in the text chat as well. So you can link to the registration. You can click a picture of the screen, the QR code, so that you can link to your feedback is very important to us. Okay, so with that being said, did you finish with that response, Dr. Johnson? I got a little caught up with the screen share.
I did.
Okay, all right, wonderful. All right, so the next question is fees. I wish I had made a different choice, but I bought a product with load fees. Now that I've paid those fees, I shouldn't take the money out of that product, right? Would switching to a no load product be like paying the fees twice?
Okay, so loads for the people in the room typically go with mutual funds. So when you buy a mutual fund, there's two different ways to do this. This is complicated, right? But big picture, there's two ways. You can either buy a load fund family or a no load fund family. Typically for the load family, you're going to pay a load to buy a fund. And that load will vary based on the fund and the fund family, but it might be, say, 5%, 6% or something, that range. When you buy fund shares, for every $100 you put into the fund, you're going to pay, say, $5 as a load, and that typically goes to pay the advisor who helped you, the saleswoman who helped you buy that fund. Typically, in most fund families, once you pay the load, you can swap trade between funds in the family at no cost, at no additional load. So once you're there, you can go from fund A to fund B to fund C to fund D at no additional load typically. Once you've paid the load, right? It's the economic word is sunk cost. You've paid the load, you can't get it back. So the old saying, like, don't cry over spilt milk, there's no way to get that load back. So simply switching at that point to a no load fund family doesn't make that investment any cheaper for you per se. So just by itself, I would not say switch. I'd say, look around and figure out where you want your money to be. What's the best place for that money now? Be mindful, if it's a taxable account, you have gains, you'll need to pay taxes on your gains if you have gains. So after taxes, is it worth selling to buy some other fund somewhere else? And that I don't know. Maybe sometimes yes, sometimes the answer might be no. So you're asking a hard question. There are people that think load funds are bad. I would say load funds come with this package of services that you pay with the load. So do you want those services? If you do, you pay for it through the load. If you don't need those services, then by all means, buy somewhere else. But don't pay that. Hopefully that answers your question.
Yeah, I think it did, and I think you made a good point about sunk funds and not crying over spilled milk. Right? You can't do things differently. You can't change things, but you can do things differently moving forward. So I think that's a great point. We did. So another one, if you didn't start saving for retirement early, are there investment strategies that you can use to catch up?
Well, so you can play Powerball, right? So look, so one of the concerns people have, that this is a very risky spot to be on, right? You wake up one day and go, hey, I am 55 years old. I want to retire when I'm 65. I saved nothing for my retirement. Like, what am I going to do? I suddenly realized I'm going to be there. I should have been saving, but I didn't. Like, so how can I make it up? So there's two ways to do this. One way is through these tax-deferred vehicles, IRA or a 401k plan. There's actually an IRS catch-up mechanism. You can make what's called catch-up contributions and add more to your portfolio. So normally in a 401k plan, people can contribute $19,500 per year to that portfolio. But if you are over age, is it 50 or 51 or something, if you're old, you can contribute an extra, it changes from year to year, but you can contribute an extra $5,000 or $6,000. That's one way to catch up. That's legitimate. You can do that, by all means, you should. If your question is there somewhere a special stock I can buy that young people can't buy, that I can double my money quickly? Be careful. If that's your tendency, and I understand it for sure, be careful because you may be susceptible to falling for fraud, right? Because at the end of the day, there is no surefire way to make lots of money very quickly. I would say if you didn't save when you were 25, spilt milk, can't make it up, I'm sorry. The best you can do is the best you can do going forward. That is invest in a collection of good products. Be mindful of how much risk you want to take, right? You're going to retire in 5 years. Do you want to invest in stocks or not? This is a question of the time diversification question. Maybe you do, maybe you don't. But be mindful there are risks there, and there are no special vehicles for old people to make money quickly, regrettably.
That's good. And it's good that you brought it back to the fraud as well and in fraud risk. Yes. So another question on retirement. If you switch from one company to another, should you switch to their 401k or switch to an IRA to keep in a 401k plan? Did I read that correctly? Did you get that?
Makes sense.
Yeah. Okay.
But typically for plans, they have a rule where if your plan balance is too small, you can't stay in that plan. You have to go somewhere else and just roll it out. And that's it's somewhere like it varies from company to company, but it may be say $2,000, $3,000, $4,000, or $5,000. But if your plan balance is say $5,000, you can leave it there or roll it to the new one or to an IRA. My question would be, look at the old plan. Is it a good plan or a bad plan? Look at the new one. Is it good or bad? And look at IRA options. Are they good or are they bad? I've had jobs in the past that had kind of crummy 401k plans. So when I left, I thought that's a bad plan. I want out of there as soon as possible. So I left the plan. There's also employer plans that are actually quite good. If you leave, that may be better than your new plan. If that's the case, leave your money where it is. It's a good plan. So for me, it's strictly look at those three options and see which one has better options for you. Which one has better mutual funds, better selection, for example, lower fees, and stay with the lower fee family, the lower fee plan, for example. That's kind of a cheap answer, I know, but it comes down to, just look at the options. That's one.
And kind of a follow-up to that, if your job does have a crummy plan, isn't it best to at least take the match, then maybe trade it to something better later? That was a question.
So one of my brothers-in-law works for a very, very small company. That firm, they have 4 funds. They're lousy funds. They're high fee funds. I would never invest in those funds. However, his employer has a dollar match for what he puts in. And so I said, hey buddy, they're bad products, they're bad funds, but when the money goes in, your money doubles overnight, right? So by all means, participate in the plan because the money doubles, do it. But for your above the match, put your money somewhere else. My advice is
no. Okay. That was the last question that I have on my end. And so I want to thank you again, Dr. Johnson, for just sharing your time and your resources with us. We will be sending out these slides and a recording tomorrow. We again encourage you to take the evaluation, to provide us feedback, and also it's a good place to put other topics that you would like to see in family and consumer sciences, but especially in family finance and resource management. I would encourage you when you get the links tomorrow that you take some time and look at the SEC's website, especially some of the investing resources that Dr. Johnson mentioned, including the webinars. And so if you're interested in learning more about investing, that is about as good of a resource as they come in terms of just vetable, reliable sources. And so take some time to look at that, check out their webinar series for more information. And then of course, make sure that you are following Family and Consumer Sciences on social media so that you're aware of programs like this that we offer throughout the year. So again, thank you, Dr. Johnson, and thank you to everyone for joining us.
Thank you. My pleasure to be here. Happy to come talk to you tonight. Thanks for coming.
All right, maybe we'll do those part, 8, 9, or 10 in the future then.
We should.
All right.
Do it again.
Good night, everyone.
Good night.